last Friday, the U.S. stock market, the S&P 500 index, hit an all-time closing high. It went above the last high, which was back in January, early January of 2022. We're now at an all-time high in the markets, and even today, the markets can continue to go higher. And so when you're an investor, when you're investing in your 401k or 403b, or maybe just your investment account, sometimes periods like this create a lot of different emotions, questions, considerations on what you should be doing when it comes to your investments. Now, the kind of conventional or perhaps intuitive way that most investors make decisions is periods like this when the market's at an all-time high. They feel like, I got to get in now. I need to invest more. Now, the counterintuitive viewpoint is, well, at some point we're going to see that pull back, so maybe we should get out of stocks or change our investments. Neither of those is necessarily right or wrong. More so, this type of tinkering with your investment accounts can create undue harm or negative implications to your investments. In fact, when you look over longer periods of time, 5 years, 10 years, even 20-year periods, and you look at the performance of the markets, the U.S. stock market has generally produced really consistent positive returns to the tune of somewhere around 7.5%, 8%, or even 9% annualized returns over those longer periods of time, depending upon when you're looking at them. But the average investor usually underperforms that somewhat significantly, sometimes by as much as 5 or 6 percentage points per year. And over a 5, 10, or even 20-year period, that is a huge difference in the growth of your account. So as exciting as it is of the markets hitting an all-time high, or as kind of nerve-wracking that maybe I should be making adjustments in case the markets go down, the real answer for you is to make sure you've got a strategy that's right for you and generally stick to that strategy. Don't worry too much about us being at an all-time high if you're 35 years old and you have another 30 years until you're going to use this account, your retirement savings. You ultimately should really stay invested, stay allocated to stocks so that you get continued growth over that 25, 30, 35-year period. Now, if you're getting close to retirement, if you're in the next, last 3.5, 5 years until you're going to start using this money, you definitely want to make sure you're invested in a way that's right for that time horizon, perhaps taking some of the risk off the table. It depends upon a number of unique factors, but we know that periods like this create that emotional decision making that generally is not a great decision for most investors. Instead, sticking to a strategy usually produces the best outcomes. If you have questions about this, questions about your investments, check out moneynav.com for a ton of information that we have and guidance, or reach out to your advisor for a one-on-one coaching session.